In the world of dividend growth or income-focused investing, the hunt for the next high-yield stock or ETF is always on our radars. And with different covered call ETFs like JEPY or even JEPQ, offering a solid strategy utilizing a covered call option approach to generating yields somewhere in the range of 10% per year. Along with the potential for some capital appreciation, this has investors like myself very interested, to say the least. But just as of recently, there is now a brand new ETF named JEPY or JEPY. This ETF recently landed on the scene, offering a very interesting strategy that aims to deliver around 30% yield to investors. Now in this video, we're going to dig deep into the new JEPY ETF and see what it has to offer, and if or if not, this could be the next big thing worth investing into. Now make sure to stick around, drop a like down below, and subscribe for more future content like this. So without wasting any time, heading over to the Defiance ETF's website, this is the company that came up with JEPY, or the S&P 500 Enhanced Option Income ETF. Now it says right here that JEPY or JEPY is the first put-right ETF on the S&P 500 using daily options, ODTE, to seek enhanced income for investors paid monthly. Now JEPY aims to achieve consistent and outsized monthly yield distributions for investors coupled with the equity market exposure to the S&P 500. Now JEPY is an actively managed exchange-traded fund or ETF that seeks enhanced income, constructed of treasuries and S&P 500 index options. The strategy's objective is to generate outsized monthly distributions by selling option premiums on a daily basis. The fund uses daily options to realize rapid time decay by selling in the money puts with ODTE. Now the investment objective is the fund's primary investment objective is to seek current income. The fund's secondary investment objective is to seek exposure to the performance of the S&P 500 index, subject to a limit on potential investment gains. Now the fund data is actually pretty funny to see. Considering it's relatively brand new, the net assets are $2.98 million only. It's currently trading at around $19.90 per share, but one of the red flags right away is the massive expense ratio of 0.99%, and this expense ratio is now sort of typical in the more severely actively managed funds like that of YieldMax or other ETFs that managers are going to have a very hands-on approach. Now I came across this article from Seeking Alpha. Shout out to Brad Thomas. He did a pretty good write-up on the JEPY ETF. Let's see what he had to say about it. He said many people like JEPY strictly for the yield alone, utilizing the ETF as purely an income play. But however, he then said, what if I told you there was a new ETF coming out with a yield north of 30%? The new ETF, referred to as the Sexy JEPY, as it has a ticker symbol of JEPY, is named the Defiance S&P 500 Enhanced Options Income ETF, and this income is taking a pure play income play to another level. The fund's primary objective is to see current income. And here's a look at the strategy that JEPY offers. Every day the fund will sell put options that are priced either at the money or up to 5% in the money, i.e. higher than the current market price. If the fund sells an option that is priced above the current market price, the fund may profit if the index increases in the value above its current price. This opportunity exists until the option's expiration date, which is typically the next day. This happens because an option priced above the current market value has a higher premium than an option priced at the current market value. In other words, the fund's potential for profit or exposure fluctuates. The potential for profit is calculated daily over a certain time period, but it's also balanced out by any losses that might occur during the same time period. The ETF is utilizing options, particularly writing put options with a one-day expiration date. Now the fund is going to be able to generate a higher yield than traditional option-based strategies like those of JEPY due to the fact that they are selling in the money puts with less than 1 day until expiration date. Most other covered call ETFs sell options within like a month time frame, but JEPY is going to be selling them within a 1-day expiration. This ETF focuses on just one contract per day, and any additional cash will be used to hold short-term US Treasuries for collateral and to generate further income. Now the JEPY's fund inception date was literally September 18th, so it's only been trading for a few days as of making this video, and so far in the max time frame, the ETF is down around 2.27%, but this is also during a time frame where the entire market has been going crazy and has been losing some value across the board. But now to get a little bit deeper into the JEPY, the Defiance S&P 500 Enhanced Option Income ETF, looking at the prospectus. It says right here the fund's option contracts provide exposure to the change in the value of the index, current income and option premium for in-the-money puts, potential income from their intrinsic value, and a limit on the fund's participation in gains, if any, of the value of the index. It then says why invest into the fund. The fund seeks to generate monthly income, which is not dependent on the price appreciation of the index. So unlike a lot of other indexes, like if you were to buy into the S&P 500 or the NASDAQ, just plain and simple, you are only going to be able to make a profit if the fund was to trade upwards. But in this case, investing into something like this, with an option ETF with this strategy, it doesn't matter if the market trades sideways, up a little bit, down a little bit, most likely this fund is going to continue to make money unless there's some drastic swings in the market. It then says the fund seeks to participate in a portion of potential gains experienced by increases in the value of the index. That is, although the fund will not fully participate in gains in the value of the index. The fund's portfolio is designed to generate income. An investment in the fund is not an investment in the index, nor is the fund an investment in a traditional passively managed index. The fund strategy will cap its potential gains if the index increases in value. The fund strategy is subject to all potential losses if the index loses value, which may or may not be offset by the income received by the fund. So even though this fund is going to be generating a massive amount of premiums, which are going to be generated from the strategy of selling in the money put options, it doesn't necessarily mean that the underlying is not going to lose value if, of course, there's some sort of massive downturn or maybe even a black swan event. Also important, it says the fund's monthly distribution. The fund will seek to provide monthly income in the form of cash distributions. The fund will seek to generate such income in the following two ways: writing and selling put option contracts on the index as described above. The index in the form of option premiums received from such option sales will be primarily influenced by the volatility of the index's value, although other factors, including interest rates, will also impact the level of income. Investing in short-term U.S. Treasury securities. The income generated by these securities will be influenced by interest rates at the time of the investment. It then goes through some more information. It shows all the different management leaders on the team for this ETF. And then also, maybe importantly, it says tax information. Fund distributions are generally taxable as ordinary income, qualified dividend income, or capital gains, or a combination, unless an investment is in an individual retirement account or IRA or other tax advantage account. Distributions on investments made through tax-deferred arrangements may be taxed later upon withdrawal of assets from these accounts. So also important when it comes to covered call ETFs, make sure you understand the tax risk if it so happens to apply to you. So Jepy is going to be pretty interesting to watch over the next few weeks, next few months. And in my opinion, we are going to see more and more different sort of unique strategy ETFs like this come about. Ever since the last few years or so, we've been seeing more and more option strategy ETFs that are starting to pop up and offer different exposure for investors. Now, of course, could you or I utilize the same exact strategy that the Defiance S&P 500 Enhanced Option Income ETF is utilizing by selling puts in the money on a different index and collect a premium? We definitely could, but buying into something for $19 or $20 and having the exposure of that strategy, all for paying around a 1% expense ratio, is sort of worth it in my opinion, if that's the sort of strategy that you want exposure to in your portfolio. Now, for me personally, am I going to buy any JEPY shares for my portfolio, and does this ETF match the strategy that I'm looking for? So when it comes to JEPY, I'm going to grab a few shares here and there just to sort of watch how it trades. But just like other sort of more volatile covered call option ETFs, these are never going to make up a majority of my overall portfolio, as I'm still trying to sort of build the foundation of my long-term dividend growth portfolio. Things like JEPY, even Jepy or JEPQ, or even things like the yield mix ETFs are always just going to be sort of satellite positions when it comes to building up my personal portfolio. But now I want to hear from you guys down below when it comes to JEPY, the strategy that the ETF has, and if you will or not be personally buying some shares of JEPY for your portfolio. Comment yes or no down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.